All right, class, I hope everyone's doing well today. I hope I'm doing well today. We're going to do a little crash course here on inflation. This is the second of the economic problems. We talked about unemployment when I was still here. A lot of this is going to be a review, so we're going to kind of fly through it, and I'll slow down on the stuff that is new, and then we'll practice some stuff. So we know inflation is when we have rising prices as measured by our consumer price index or another price index over time. And I just gave you a list of the costs of inflation. You can look through those on your own. You know most of them. You know, your money buys less. It makes you less likely to save because prices are going up. A couple of important ones, though. Number one, interest rates on banks are going to go up. If there's going to be inflation, it means money's losing value. So if money's losing value, banks have to charge a higher real interest rate. And we'll take a look at that in a moment. You can read the rest of those on your own. Now let's focus on that interest rate concept. It's an effect, and I apologize for my handwriting, called the Fisher effect. And occasionally you'll see this asked on the test, but we show the Fisher effect on a loanable funds model. So let's say we have our loanable funds. Remember, we have our suppliers who are our savers and our demanders who are our borrowers. And let's say here is our interest rate. Now, we have a built-in expectation of inflation. Why? Well, because past experience. You've been on this earth long enough to know that every year prices go up a little bit. And you have that expectation of how much prices will go up based on how much they've gone up in the last few years. Banks have the same thing. And they build in that expectation of inflation into their interest rates. So if they expect there to be 2% inflation, obviously they have to charge that 2% plus when they charge an interest rate to counteract the fact that that money is going to be losing value. So let's say that at that interest rate, the expected rate of inflation, we'll call it expected inflation, is 2%. And let's say that the interest rate that they're charging, let's say this is a nominal interest rate. We'll write that up here. The nominal interest rate they're charging is 6. Okay. What that means is that in a given year, they're planning to make 4% real interest on that loan. You take the 6% nominal rate that they're charging, you subtract the fact that they're losing 2% because of the inflation, and what they're really making, the real interest rate, is 4. Now, if years go by, a couple years go by, and that expected inflation actually goes up to 4, if we're seeing higher inflation, and everybody starts to assume that that inflation rate is going to be higher, then what's going to happen is the banks are going to have to charge more nominally to make up for the fact that the inflation rate has gone up. So, simple thing. All you'd have to do is if expected inflation went from 2 to 4, then nominal interest would go from 6 to 8. Okay, so what we'd say is, okay, the new nominal interest rate is 8%. And then you can just come up here and you can draw a new curve. And literally what would happen is both curves would shift for that new nominal interest rate. You can see the quantity of loans they've given out. That hasn't changed. So really all the Fisher effect is saying is that for every 1% increase in inflation, there will be a 1% increase in nominal interest. That's the Fisher effect. It doesn't change the amount of profit, so to speak, that the bank is making, because the real interest rate, remember here, it was 6 minus 2, and they were making 4% real interest. Now it's nominal 8 minus inflation 4. They're still making 4% real interest. So that doesn't change. Now, besides inflation, we have deflation. You know what that is. You know that prices fall over time. Exact opposite. And deflation is interesting because it can be both good and bad. Good deflation, you can see here, is caused by a positive SRAS shock. You know, those are usually like lower commodity prices like oil, steel, things like that. And you can see why we call that good deflation, because, yeah, price levels are falling, but at the same time, output is rising. We're more productive as a country. That means that wages can go up. And it also means that the unemployment rate is falling. So you can see why we'd call that good deflation. Bad deflation over here is caused by a negative AD shock. Generally, we have bad deflations during severe recessions. This could be a stock market crash. And we can see prices are falling, but we know that output is also falling, which will lead to lower wages in the long run and also higher unemployment. So good deflation, positive SRAS, bad deflation, negative AD. We also have a concept called disinflation. Disinflation does not mean that prices are falling. That means that the inflation rate is falling. So if in 1 year you have 8% inflation and the next year you have 6% inflation, you can see prices are still rising, but they're rising at a lower rate. That's called disinflation. So if you see here on the map or on our graph, and I'm going to go through this really quick, the CPI, you can see what years were inflationary. Well, from here to here and then here on up, you have inflation. Prices are rising to some extent. What years are deflationary? Well, everything in that triangle there, prices are actually falling. If you go down here, what years were disinflation occurring? Well, we have disinflation here. Well, prices are rising. They're rising at a lower rate. We have disinflation here. We have disinflation there. And then lastly, what years was deflation decreasing? That's kind of a weird way to put it. But disinflation decrease, or deflation, deflation decreasing is when you have prices still falling, but falling at a slower rate. So I know I went through that quick. You can come back and look at that again. I only have 15 minutes to do these, so I got to fly. Now, why is bad deflation? Let's put that up there. Costs of bad deflation. Well, we know since it happens during a recession, it's usually going to cause unemployment. That unemployment means people are going to spend less money, can lead to more deflation. We call that a deflationary spiral. Businesses are not going to want to invest and spend because the poor economy. And it really, and this is important, it really hurts people that borrow money. Because what happens is you borrow money, you have an interest rate, maybe a mortgage, an auto loan, things like that, and you might lose your job, or maybe wages start to fall in the long run because of the deflation. But guess what? The amount that you have to pay on your debt, now that's not going to go down. So when you have deflation, it's really bad for people whom owe money. We call that debt deflation. Now, let's get into the how inflation is measured concept here. We know that we most commonly use the CPI. We've looked at that before in Unit 2. We've talked about the market basket, the categories of goods. We've looked at that before. We'll look at it in more detail in a bit. Here are some of the categories of goods. You can take a look at those. You can see that we actually weight them. And the reason why is because not every category is going to be as important. You guys know if the price of shoes were to double, that would be less significant than, let's say, if the price of wheat or dairy were to double, or the price of fuel or healthcare. Healthcare is not as much there, but you can see that some things have a bigger impact on our spending than others. Now, we know that there's problems measuring inflation. The market basket is just a sample. It's not for everybody. There's data collection errors. There's statistical issues. You can look through that on your own. Now, causes of inflation. This is important. When we look at causes of inflation, we usually use an ASAD model, but you don't have to use the LRAS because it doesn't really matter. We're just looking at the prices rising. The first type of inflation we call demand pull inflation. And it's caused, same thing we've looked at in the past, caused by a positive AD shock. AD moves to the right. Why? An increase in wealth. Stock market's doing really well. Increase in confidence. Maybe taxes get lowered. Government spending increases. Interest rates fall. Things like that. AD shifts to the right. We have price levels rising. This is what we kind of think of as our normal inflation. We've looked at that a lot. We know prices go up. Output also goes up, unemployment falls. That's going to make people spend more money. Okay, so that's demand pull inflation. The cool thing about these inflations, they're kind of dummy proof. Okay, demand pull inflation. What causes it? Well, a rise in demand. So here's another reason why you really need to know those supply and demand shocks. Next type of inflation is what we call cost push inflation. Again, exactly what it sounds like. It's the cost of production, the cost of raw materials. This could be any of our SRAS shacks, an increase in nominal wages, an increase in commodity prices, an increase in corporate income taxes. But you can see again what we have there is a negative SRAS shock. SRAS goes to the left. That drives up prices. Cost push inflation is problematic, obviously, because it's also what we think of as a stagflationary shock, because output is falling and unemployment is rising. Okay, so again, cost push, rising input costs for production. Now this one, don't get blown away by this. It's not really as complicated as it looks. This is called the inflationary spiral or the wage price spiral. And it's basically saying that one type of inflation will cause the other type of inflation. So let's say, for example, we are here where AD1 and SRAS1 intersects. And let's say there's a major increase in oil. Okay? Now, when those oil costs go up, you're going to have a negative supply shock. SRAS is going to go to the left. That's going to cause cost push inflation. However, with those higher prices, workers are going to begin to demand higher wages to be able to pay for that. Incomes may start to increase, okay? And as incomes increase, AD goes to the right, and then you have demand pull inflation. Well, as incomes go up, we know the nominal wages that firms have to pay also go up. We know nominal wages is an SRAS shock. And then, bam, you have cost push inflation. Well, once again, now with that extra inflation, workers are going to demand more income, okay? And you can see the spiral can literally just continue if there's no action taken or nothing happens to stop it. It's concurrent demand pull, cost push inflation. We call that the inflationary spiral, when one type of inflation causes the other type of inflation. And that's how you can, sometimes run into galloping or hyperinflation, when you get into that spiral and you don't get out. Some economists known as the school of monetarism that was really developed in the 1950s and beyond believe that what really causes inflation is monetary growth. They look at the supply curve and they really only focus on the long run supply curve. And they say what happens is when we know this, we talked about it, when more money is printed and put into the money supply, we know that money will then be loaned out and it will be spent. And the goal of that is to increase AD. But we know in the long run, the economy will always be at or around full employment. So what you see happening is that increased expansion of the money supply really in the long run is only causing inflation. So monetarists, their main belief is that inflation is caused by nothing really than just too much money supply. Now remember, a little bit of inflation is a good thing. Okay, remember every year we want there to be a couple of % inflation simply because it means that we have to put our money and save our money in something interest bearing to make up for that inflation, and that money is then available for investment spending. So we talked about all that demand pull, cost push inflation. That's only a negative if it's too much. And too much inflation becomes problematic. We also have to remember that when inflation is too high, okay, very high inflation, well, deflation is bad for borrowers. Really high inflation is bad for banks, okay? So I'm going to write that there. High inflation, you might want to write this, banks lose. Okay. Why do banks lose? Well, if they give out a loan at a certain interest rate and there's high inflation, it's going to eventually mean that wages are going to start to rise. And that's going to make it easier for the debtors to pay back their loans. And it's going to mean they're paying back their loans with money that is worth less. And that's not good for banks in the long run. It's good for borrowers, bad for banks. So you'll sometimes see that question on the AP. Very high inflation. Who wins? Borrowers win. Banks lose. When there is deflation, okay, banks win, borrowers lose. And just think about the value of the money that they're paying back in each scenario. The government policies to deal with inflation, you guys can read this on your own. We've done these before. We know that when it's demand pull, you got to use demand side policies, fiscal and monetary. Cost push, you're going to see more of the supply side policies. And we're going to stop here. You have some work to do. The sub should help you with that. Have a great day, guys.